Hello, this is Peter Bell. Welcome to Keith Weiner. First time on a call together. Hello, Keith.
Hey, Peter, how are you? Thanks for having me.
Pleasure. Thanks, Mickey Fulp, very much for organizing.
Well, thank you, Peter, for your organization of this too. We suggested this during the Capitalism and Morality Symposium, and we appreciate you taking the lead on this.
I actually missed Keith's speech at the symposium, so I very much look forward to talking with him about it. Read some of the stuff from your website, Keith. Wow, very, very impressive. And if I could start with a quote from one of Mickey Fulp's Monday Musings, April 15th, 2013, one titled, "If you keep your money with the banksters, they are laughing out loud." It's a quote from Lord Byron, where he said, "Oh, gold, I still prefer thee unto paper, which makes bank credit like a bark of vapor." It's a famous long poem from, as the British Library says, a mad, bad, and dangerous to know poem, as it was described at the time. The story of Don Juan, a famous womanizer, but it's been flipped around, and he himself is the seduced many times over. And it contains some provocative digressions on social commentary. "Oh, gold, I still prefer thee unto paper, which makes bank credit like a bark of vapor." So, to start off, Mickey, I'd like to ask you, why do we care about monetary economics?
Well, if you have assets, of course you care about monetary economics, and I'm a strong proponent to the idea that gold is the only real money, and we have seen throughout the history of man that fiat currencies continually fail, basically because governments continuously devalue those through inflation.
And Mickey, again, if I could ask, any favorite parts that you remember from Keith's speech at Morality and Capitalism?
Well, I was impressed. I quite enjoyed Keith's speech. Correct me if I'm wrong, Keith. The title was "Inflation is Counterfeiting," and so I was duly impressed with your catch-22 analogy on money and debt, and perhaps you would like to elucidate on that.
I was going to say, an impartial answer to Peter's question about why should we care, there's a fairly famous quote of John Maynard Keynes citing Vladimir Lenin. And, most people know the quote about there's, or at least the first part, there's no surer way to overthrow the capitalist order than by debauching the money.
Yeah.
I'm not quite getting it exactly right, but it's something like that. But it goes on and on and on, and the latter part of it isn't as well known. And the last part of the quote is when he says, "By engaging all of the hidden forces of economics in favor of destruction, and not one in a million can diagnose what's happening." And of course, today our term for the hidden forces of economics would be incentives. I think we understand incentives a little better today than they did back when Keynes wrote that, or when Lenin allegedly said that. And the problem with our system is that it creates a perverse incentive, or many perverse incentives, for people to consume their wealth, for people to destroy capital, because our system makes it profitable to do so. And anybody that has any degree of wealth or capital should be concerned. So the mainstream view, I think, is pretty well summarized. I attended a session of what's called the Shadow Open Market Committee. These are a bunch of monetarists that get together, presumed to criticize the Fed, but it's a friendly criticism. Basically saying, "Hey guys, you missed an opportunity to raise the federal funds rate 25 bips, 4 months ago. According to the Taylor rule, you should have bumped it up to whatever." And they had Dick Fisher as the keynote speaker in this particular one. Dick Fisher at the time was the, what, you're laughing now, wait till you hear the punchline. He was the president of the Dallas Fed at the time. So he gives this talk and whatever. And then there's a question in the Q&A from somebody in the audience who said, what do you think of the wealth effect? Economists have this term wealth effect that basically when the stock market's rising, GDP rises, people spend more, blah, 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 blah. Very antiseptic idea. That was one of the themes of my talk in Capitalism and Morality, was how everything in modern economics is very antiseptic and doesn't really give a clear indication of failing. So anyways, so he hears the question, what do you think of the wealth effect? And he spreads his hands in this very broad gesture, palms out. And he's a charismatic guy, and he has this big, deep belly laugh. Oh, the wealth effect. Oh, let me just say, the wealthy have been very affected. And then the entire room, bursts out into this polite golf clap, because everybody in the room is either a 1%er or aspiring to be a 1%er. An academic was hoping to revolve through the door and end up at an investment bank.
Wow.
And so all of these folks, I'm sitting here thinking, you son of a bitch. I'm sure I was the only one in the room thinking that, the gold guy in a room full of monetarists. But so they think that they're getting richer by a wealth transfer scheme from the poor to the rich, which is the same error that the socialists make. The poor don't have any wealth. If the rich are getting richer, it isn't because they're getting it from the poor. There's nothing to get. And if they, and the middle class feels like they're getting richer too when their house prices go up. And so, of course, nobody's getting richer. The Fed can't print wealth. It's not an increase in wealth. What's happening is an increase in perceived wealth. The wealth effect is not actual wealth. It's a feeling of being richer. And so creating that effect, they incentivize people to consume their capital. And that is the theme of our era.
Amazing. Just to reflect back and say that I hear you referring to economic warfare there a bit, Keith, and the antiseptic, anti-biological ideas in economics seem very pervasive. Physics envy, as opposed to maybe what should be a little bit more biological based hard science models in economics. Social science models are always hard, but I think biological ones might be more useful than ones taken from physics and hard math. But I'm a math background myself, and there are really good models of biological systems that surely have application all aspects of economics. And to hear the word antiseptic, it's very much counter cyclical everything, right? As opposed to trying to embrace systems and their dynamics.
I would like to ask Keith to explain a bit of his talk about the catch-22 of money and debt. I thought that circular reasoning was it was eye-opening to me, and the idea that inflation is counterfeiting.
So, very quickly, my definition of legitimate, honest credit is there's four criteria that have to be met. Two are on the lender side and two are on the borrower side. The lender, first of all, has to be aware that his funds are being lent. If something is being done on the down low and he doesn't even know about it, then that's already wrong. Number two, obviously, he has to consent. He has to agree, I'll give you my money for this time period. And generally, there's only one reason that will make him do that, and that is he's being paid interest. If he's not being paid interest, then why in the world would he agree to lend his money? And there are two criteria on the borrower side. The first is that the borrower has the means to repay. Now, that's a really critical thing. That means that generally, if we're talking about business borrowing and leaving aside that consumers can borrow to buy iPhones, that generally means the business is borrowing to invest in an asset. It could be they're borrowing to invest in putting the infrastructure to turn a gold ore body into a mine. It could be that they're borrowing to put in a railroad line. It could be they're borrowing to buy machinery that stamps out widgets. There has to be the means to repay the debt, and then finally there has to be the intent. And so if you look at our monetary system today, all four of those things are missing. People feel that if they have a dollar bill in their hand, they have money. and that they're not actually a creditor. But of course, bill is an archaic word for credit. If you take out a dollar bill and look at it, it doesn't say bill on it, it says note, which is short for promissory note, Federal Reserve note, which means the Fed owes you something. And so it's actually a credit instrument by which you are granting credit to the Fed, and the Fed thereby is enabled to grant credit to the banking system and to the government. So you don't know and you don't agree to extend credit, and yet that is precisely what you're doing. But it gets worse, and the paradox is we use these Federal Reserve notes, or the electronic equivalent, to pay debts. But the Federal Reserve note is itself a credit, is itself a debt.
Right.
We use a debt to pay debts, which means there literally is not a mechanism to repay. People look at the national debt at I think it's up to 21.3 trillion at the moment. If you close your eyes and don't look for a few days, it bumps up another 100 billion or so. And they think, okay, well, if Congress simply had discipline and the president, signed the right legislation and so forth, then, we could pay that off. But the fact is, we pay our debts using an IOU. And so the debt is never, I'll use the technical term, extinguished. It's merely shifted around while it continues to grow exponentially. That is, it doubles approximately every 8 years.
I got quite a kick out of that during your speech. I was reading on your blog here a thing you wrote about J.P. Morgan, about credit and banking and money and gold and character, and the idea that he had that the most important part of all that was character. And then the idea that gold has no third-party risk. And that's the reason I own physical gold, because it does not have any third-party risk. And to my knowledge, it's the only monetary instrument that does not have third-party risk. As I think you quoted during your speech, and I think it's attributed to Grant Williams, gold is the only financial risk instrument that cannot go no bid. I think that's profound.
Yeah, that's right. And right, that people looking at it from the dollar perspective say other assets go no bid, and gold is the only asset that goes no bid. And so my argument there is, if you realize gold is money, and the dollar is actually the thing being bought and sold. So from a gold perspective, if gold was drawing its bid on the dollar can go no bid. And the people that are trapped in the dollar thinking paradigm think gold has gone no bid, but actually it's gold's withdrawal of its bid on the dollar. So it's a bit of a paradigm shift, but when you do that, things become simpler. And my analogy there is, before Copernicus, the medieval people thought that all the planets and the sun revolved around the Earth. And so they had this complicated math to try to describe the orbits of all these planets with this so-called retrograde motion, that the planets would be moving and then they would reverse for a little bit and then continue in their path. And so the math to describe that is complicated, and theoretically nobody could come up with a reason for why that would be so. As soon as Copernicus said, wait a minute, it's the sun in the center, we're going around the sun and so are the other planets, then not only did the math become much simpler, now it's just, well, I thought it was a circle, it turns out later it was an ellipse. But in terms of explaining the causes of things, it was a much, much simpler model. And that's what I'm proposing here. If you think the dollar is money, then you have to say, why is gold the only thing in existence that does not go no bid, whereas everything else can go no bid in a crisis? But if gold is money, then everything holds true. It's the dollar going no bid, which makes sense because that's the sort of crisis where the government itself, the full faith and credit, so-called, of the U.S. government is itself being called into question. And by the way, this is not entirely theoretical. This began to happen in fall of 2008. And so the measure of gold withdrawing its bid on the dollar is backwardation, which should never occur in gold and had never, in fact, occurred we have the data, Monetary Metals has the data to prove it, had never ever occurred except for one brief day during the Gordon Brown's bottom episode when he sold half of the UK's gold. It was a day of backwardation, but other than that, it never occurred until December of 2008.
Do you mean across the entire curve?
No, it was only, I'd have to go look at our data, but I believe it was only the December and February contracts. Actually, it might have been April as well. But it didn't extend any farther than that. But the fact that February had backwardation, and by the way, that backwardation was significant.
Yeah.
It was in the magnitude of about 3% annualized.
Do you think that was just reflecting, really bullish sentiment in the cash markets? Or
I think it was reflecting fear of counterparty solvency.
Yeah.
That in the game of musical chairs.
Which is bullish for cash market gold, spot gold delivery, like physical.
Right. Well, not bullish in the sense of people suddenly saying, I want to bet on its price, but rather people saying, so when backwardation occurs, there's a trade that you can do that by conventional thinking is risk-free. That is, you can give up your bar of gold in exchange for a paper contract to deliver it back to you and get a profit for doing so. And when everybody in the gold market stares at that and refuses to take the profit being offered, it's no longer about greed, it's now about fear. It's not the price of gold will go higher. It's if I give up my gold bar in exchange for a piece of paper, I'm not going to get my gold back. Or I fear that I won't. And
it's one wonderful insight into futures markets, physical markets, and monetary system too, right? For monetary metals.
So that backwardation has recurred intermittently. It has sputtered on and off in both the gold and silver markets ever since 2008, and it had not been occurring previous to that. And so
I had no idea it never occurred previously.
Yeah, we have all the data going back to 1996. It's all published on monetary-metals.com, and we have some articles looking at the Warren Buffett silver episode and what that did to the curve and various contracts, and the Gordon Brown an article on that and showing the data, zooming in, and so that process of the withdrawal of the gold bid on the dollar has been undergoing. Now, at the moment, it's quiescent. At the moment, it has subsided and is not really an issue. But it has sputtered intermittently for years, going on 10 years now. And that's very worrying, because if gold withdraws its bid entirely and gold goes into permanent backwardation, yes, of course, you're going to see a skyrocketing price of gold. And that will be an opportunity at first for those who own gold to unload it at what they think is great profits. However, if the backwardation isn't cured, it will drag all other commodities into an equal degree of backwardation. So if gold's in a 10% backwardation, then that means by arbitrage, it will pull oil and wheat and everything else into a 10% backwardation. And as the backwardation rises in gold, it will rise in everything else. The reason being, there will always be demand on the part of people with dollars to get some gold, even if there is not any demand on the part of people with gold to get dollars, especially in a failing system in the endgame, which isn't today, but I'm painting a picture of what's coming. And so what is going to happen by a process of arbitrage is it will pull the prices of all commodities to infinity. And that's not going to be because of an infinite quantity of dollars being printed. It's going to be because people are using commodities. If gold doesn't bid on the dollar, gold still bids on, let's say, oil.
Yeah.
So people with dollars are going to say, oh, fine, I can just buy oil and then dump my oil on the gold bid for oil. And that's my back door to get into gold. And so what's going to happen is that will push the price of oil to infinity in dollar terms and near zero, but never actually zero in gold terms. So at the end of the process, I imagine you'd be able to I picture getting a super tanker full of oil, including the super tanker, for a couple of ounces of gold.
Yeah.
Because of that desperate rush at the end. That, of course, is the destruction of our entire system, not something that people who own gold should be, looking forward to.
No, certainly not.
So do you not need to separate the idea of paper gold versus physical gold in that scenario?
Well, right, and
Yeah.
that's a scenario where the price of gold in the futures market no longer follows or no longer tracks the price of gold in actual gold, and that's because nobody trusts the counterparty to be able to deliver the gold anymore.
Right. So that would, in my simple-mindedness here, that would be a reason to own physical gold and have it in your physical possession at all times.
Right, because then obviously you're not subject to that.
Right.
If
And
I can interject briefly, gentlemen, just on that, Mickey, I would say you may entail being an outlaw at that point.
Well, I may entail being an outlaw at this point too. So, yeah. So maybe we'll switch course here a bit. And I've already, I'm a well-known proponent of owning physical gold and having it in your physical possession to avoid, in the latter part, to avoid the third-party risk. It's a well-known fact that gold has no third-party risk if you own it physically. But it seems to me if you buy paper gold through an ETF, or even if you store your gold in someone else's vault, you have introduced a third-party risk that in some ways defeats the reason to own gold.
Yeah, I mean, what can you say to that? Obviously, either you have it or you don't. I think I would make a distinction between the risk that the operator of the vault is going to steal your gold versus the risk that if there's a counterparty that has a liability to you, they owe you gold, the counterparty could be honest and insolvent. And so you might get your gold back not because they lied or cheated, but because they're a bank, and as the system fails and the banks become insolvent, they honestly fail to deliver the gold per contract.
Yeah, or a government steps in and freezes assets. So your gold is, let's say you're storing gold on the Isle of Jersey, and you live in the U.S., and the world's financial system collapses. Assuming you can get to the Isle of Jersey, can you get your gold at that point? And so that's one reason I, once again, am a huge proponent of having it in your physical possession.
Something similar to that happened to clients of, what was the name just slipped my mind, the big futures and commodity broker that went bankrupt.
Oh yes.
Man Financial, wasn't it?
No, the one in the U.S. in 2013, I want to say.
Yeah.
I'm drawing a blank on that, but you're right about that.
Big Chicago broker, and they had John Corzine was the CEO.
Yeah.
So anyways, and this happened to some friends of mine. There were people that had gold, basically warehouse receipts. So if you buy a COMEX gold future, there's a 100-ounce gold bar that you can demand, and if you put in the cash, so if you put in $120,000 today, then you can take delivery of it, and then basically there's a serial numbered bar at a particular warehouse with a particular hallmark that is yours, but that warehouse receipt is in your brokerage account. And what people didn't realize was the MF Global was the firm.
Yes, correct.
What people didn't realize is that if that receipt is in your brokerage account, the brokerage had the right to hypothecate it. That is, they take your warehouse receipt and use that as collateral against whatever proprietary trading position that the firm was putting on, which is not necessarily what people expected. We'll just leave it at that. And so when MF Global, I think they were betting on Greek government bond derivatives or something. I don't know what the bet that they were making, but basically they went broke. And then all of people thought they had a warehouse receipt. Now, there was nothing wrong with the warehouse. COMEX didn't default. Brinks and Loomis and whoever operates those vaults, including Delaware Depository as a licensed COMEX vault for silver. The vaults didn't steal anything, and the vault didn't go bankrupt. The COMEX exchange didn't steal anything, and they didn't go bankrupt. The problem is MF Global, per their brokerage agreement, it was in the agreement with their clients, had pledged all of their clients' assets as collateral on their leveraged bet on Greek government bonds. And so the creditors, MF Global's creditors, petitioned the court that all this would be scraped into the bankruptcy estate. That was litigated. I think at the end of the day, the creditors were made whole or close to whole. But of course, there was a 3 or 4 year period when they didn't have their gold, number one, and then number two, because the government doesn't recognize gold as money, what they do is they say, okay, 100 ounces, if that happened today, that's a $120,000 claim. And so you become a $120,000 claimant in the bankruptcy court. 4 years from now, if the gold price is $2,400, let's say, and they give you back 100 cents on the dollar, they give you back your $120,000 as they deem it. And then you say, well, this was a gold position for me. You can buy 50 ounces of gold. You've lost half your gold position, even though officially they've made you whole. You have no complaint. And so, the real thing there is if you think you have physical gold, make sure that you understand the structure in which that is owned, and if there's a counterparty between you and that gold, which there is in the case of GLD, and at least with the MF Global agreement, there was a counterparty between you and that warehouse receipt there, even if the warehouse isn't stealing it. That was kind of my point.
Yes, correct.
And let me mention the names: National Gold Exchange, Mint Line, Alliance Precious Metals, I believe Bullion Reserve of North America. They go on and on. fatcatinvest.com/caveat-emptor. Article out today talking about all of this in the US with these online bullion exchange storage companies, reputable companies advertising on Fox and MSNBC, American media channels, and just the blatant fraud and ripoff apparently that have gone largely unpunished in some way or disproportionately. White collar crime, home restricted to staying in this palatial home that you built with the money that may have been stolen from people who are claimants in a lawsuit that's yet to go to the court, or who knows. I shocking stuff all around. Thank you all very much, you guys.
When you start seeing mainstream ads on CNBC and Fox Business and Bloomberg about now's the time to buy gold or silver, it's probably something that you should find alternative ways. And there are very easy ways to buy physical gold, physical silver, platinum, palladium, etc., both in the U.S. and Canada. If anybody's interested that's listening, you can email me at contact@mercenarygeologist.com, and I can give you a couple of ideas about where to buy physical precious metals by reputable people at low markups.
Thank you, Mickey.
I was going to say, was Alliance the company that offered people basically leverage or margin, where you could buy 2 or 3 times the amount of gold that your money would otherwise buy? And then, so they're basically running an unregulated futures exchange without any of the safeguards that a futures exchange would have. And then on top of that, I think it was one of those companies, I don't know if it was Alliance, that wasn't actually putting in the offsetting trades into the market. They were betting against their clients. And, so it's obviously a Ponzi scheme, and then it blew up and the regulators went in and I don't know which company it was, but there was one that was doing something like that.
Shocking. Terrible.
Well, yeah, the romance of gold can suck people into um, speculations of shady, shadowy demeanor, and it really has to do with greed. People always are trying to make. I think it's human nature to make a quick buck without really working for it, and very seldom do schemes like that actually pan out.
Yeah. And funny to think, Mickey, that as shady as it ultimately proved to be with some of these companies, these were out in the limelight with ads on the major American TV network channels. I don't watch them myself. I wouldn't have seen it, but millions of people did and acted on it. It's shocking.
Well, yeah, it reminds me, and this is back in the day, and I think it occurred perhaps right after the global economic crisis, and it was Ed McMahon, uh, who people my age remember as the sidekick on the Tonight Show with Johnny Carson. Ed McMahon was selling gold over the internet, and yeah, when you start seeing that market in the mainstream, it's probably time to turn off the television, in my opinion.
That and when the shoeshine boy is giving you want to buy a gold stock.
Now there you go. Stock tips from the from your barber and your shoeshine guy. So
Keith, there was your most recent article on your website. Absolutely stunning. Wondering if I can read it out, a brief little excerpt of it, and maybe discuss.
Sure.
It starts off from the middle of the article, a fragment here that was particularly impactful. I thought, quote, I propose a different metric, a ratio of a worker's pay to the value he produces. For example, suppose the gross profits generated by burger flipper's work is $15 per hour. His pay is $7.50. Therefore, there is a 2-to-1 ratio. He's paid half the value he creates. Now consider his manager. Manager supervises 10 workers. Assuming all have equal productivity, total gross value is 150. Manager is paid 15. Then the same ratio moves up quite a lot. It's 10-to-1. Finally, let's go all the way up to the CEO. If the firm's gross profits are $15 million, then this ratio is 1,000-to-1. And so you're describing a situation where CEO compensation looks totally out of whack when you look at the lowest worker on the pyramid versus the highest worker on the pyramid within an organization. People look at that ratio and say, oh, it's crazy, it's outrageous. And then you're illustrating here very clearly that if you look at these same relationships slightly differently, you might find that it all of a sudden makes a lot more sense. Very clear kind of textbook argument, I thought, put forward there. And to be honest, all the years I spent studying economics and things like this, I was shocked I'd never encountered it before. So good for you. Very well done.
Well, I think to Mickey's point that he just made a moment ago, it's just all too many people that think that they can make a buck for doing nothing. But at the end of the day, that's not sustainable. And if too many people in the economy think that, then you get to Venezuela. But I think that most people want to add value in some way. And in my theory of economics, what you get paid, whether it's your wage or your profit, is just a fraction of the value you create. And so you want to create as much value as you can, because you're only going to capture a fraction of it for yourself. Most of that value is going to go to your customers, of course. Otherwise, they wouldn't be paying you. And so the argument there is essentially, I mean, what I was trying to do in that article, if I remember my mindset at the time, right? So the problem with socialism, people say, well, it doesn't work, it's this and that. And I say, I think socialism is two things. It's one is magical thinking, to each according to his need, but the universe doesn't provide that guarantee. You add up the sum total of everybody's needs, it doesn't necessarily mean that that's going to be created. But then with that magical thinking, the other half of it, from each according to his ability, is envy. You're not saying that, it's economically inefficient for CEOs to get paid that. They're saying he's rich, get him. And they make all of these rubbish arguments for why the CEO shouldn't be allowed to be. Obviously, ultimately, they want a law why he shouldn't be allowed to be paid that. And so, in that article, I was responding. I think a lot of people have made pretty good moral arguments, but I want to make the economic argument that, hey, you know what? He's not actually overpaid, and in the free market, nobody is overpaid. And in fact, going further, the more value you create, the less pay you get in proportion to the value you've created. And if you go all the way up to the CEO, he's getting paid 1/10 of 1% of the value he's created, which is, and he's perfectly happy with that. He's not whining, "Hey, I'm underpaid." It's just how the market works.
And scrolling through your website some more, I see a chart of the benchmark 10-year Treasury bond from 1946 through 69, and it's shocking to see the rates down, below 3%, around 2% there, back in the 50s, in the late 40s after World War II. Like, it seems so similar to current conditions almost, and I wonder, if there's some parallels between the economic conditions of war in the U.S. Circa World War II, and the post-global financial crisis, monetarist interventions, which, if you listen to Lenin, it's economic warfare by another name, or at least there's parts of economic warfare potentially at play around the world.
And so I have a theory that I'll try to state very simply. The Fed, the central bank, is created to enable the government to borrow and spend more than otherwise could. And people like spending, but they don't like taxes so much. And so if you create a central bank, the central bank buys the government bonds. The lender is both unknowing and unwilling, but through the mechanism of the central bank, everybody extends their credit to the government. But that's the intention. You create a central bank, you push the interest rate down below time preference. Okay, this is getting back to the old debate between von Bauer and Mises. What creates the rate of interest in the market? And time preference is the key thing. So if you push the market rate of interest artificially, you manipulate it below time preference, then what you get is a cycle of rising interest rates and rising prices. And that's what the Fed created starting shortly after 1913 when it was founded. And so that goes up to the 1920s, and then eventually the cycle turns the other way, and interest gets above marginal productivity. So a falling interest rate drives down productivity, and so you get things invert, and then you get a falling interest rate, which you get through the entire Depression and through World War II, and that ends in 1947. And then it gets the other way again. It gets inverted, and interest is below time preference. And it became absolutely insane in the 1970s. I can recall as a kid in the late 1970s, my parents would go to the grocery store, and then let's say cans of tuna fish are on sale. And they would buy 50 or 100 cans of tuna fish. You had two shopping carts, one for the tuna fish and one for all the groceries. Because it was better to keep your wealth stored in tuna fish in the pantry than it was to keep it in the bank, because prices every week you'd go to the grocery store and the prices had moved up.
Yeah.
It was relentless. It was brutal.
Yeah.
And so a chance to buy, especially on sale, that made sense. And so that trend exhausted itself by 1981. And people credit Reagan and Volcker, but it was just the end of a 34-year rising cycle. And then the falling cycle began in 1981, and we're still in that falling cycle. I will absolutely stick my neck out and say interest rates are still falling. This is just the latest correction. There's been many corrections along the way since 1981. And so use the word warfare, I would use the word financial repression, of how people are screwed, particularly anybody working for wages trying to save for retirement, and anybody who is retired trying to live on the interest on their savings are deprived of the ability to do that. And the Fed is essentially saying, come into the stock market, the water's fine. And that's not an appropriate investment for somebody who's in the 70s with no more earnings power to just go plow all his money into the stock market.
Is the U.S. the last bastion of sanity today in terms of interest rates in the Western world? Do we see negative nominal rates in the USA?
We will.
Yeah.
To me, it's only just a question of, do we have negative rates first, or does the system blow up first? So in my dissertation, I argue there's some indicators for Armageddon. One of which is that when interest on the long bond gets to zero, which has happened in Switzerland and it's happened in other places. Well, depending on what you call the long bond, I think in Japan, the 10-year hit zero at one point, but not in the dollar, the reserve currency. And so as we get to zero, some really funny things begin to happen. We talked earlier about physics envy. There's a lot of funny things that happen around the speed of light, around absolute zero temperature, etc. Well, something very funny happens at zero interest rate, and that is the net present value of debt, and for that matter, the net present value of paying a wage. Right? What's the value of a payment to be made in 1 year's time? Well, it's the nominal value of that payment discounted by the interest rate.
Yeah.
What do you do if the interest rate's zero? There's no discount. And so something is a perpetuity, like a wage, or all debt today is effectively perpetuity, then the net present value goes to infinity. It's like a singularity, like a black hole. All the math and all the physics gets very funny around the event horizon and around the actual center of the black hole. All the conventional math breaks down, and you get Hawking debating with whomever about how it's supposed to work. The same thing happens in the monetary system.
Is this not? How much is this driven by generational cycles? I think about the wars, and is this is the global financial crisis the cross to bear for this young generation?
I don't really see it. I mean, there are things that are clearly cyclical about it, and Kondratiev was definitely onto something. I think he was the first guy to really look at things cyclical in that sense. But I think it's really a cycle. Getting back to physics and engineering, I'm sure you would both be familiar with the collapse of the Tacoma Narrows Bridge.
Yes.
So it's actually on YouTube for anybody who hasn't seen it. And so here's this bridge they built in the late 1940s, I think, that they put this bridge in this gorge, and unbeknownst to them, there's this wind that gusts down the gorge, but it's not a steady state wind. The wind has a period to it. And the periodicity of the wind matches the resonant frequency of the bridge. And so with each gust, the amplitude, it was a torsional wave in the bridge, the amplitude of that wave is increasing. And the bridge is twisting, clockwise and counterclockwise until, eventually the amplitude grew too great and the steel, sheared or whatever happened and pulled apart and the whole thing dumped into the water. Well, I see what the Fed and other government intrusions into the monetary system doing as like periodic inputs into a resonant system. And so I don't think the cycle is intrinsic to markets, and I don't think it has anything to do with the baby boomers getting older, or my generation, Generation X, being a smaller generation, or the millennials being a little bigger, or whatever. I see it as the Fed has set up this resonant system, and they're injecting energy into it, and they're trying to be reactive, right? So they try to look at inflation, so-called, in retrospect, and then say, oh, well, we're going to change our interest rate. And so the Fed is acting as that gust of wind with a period close enough to the resonant frequency of the system that you get these, you get these cycles with the amplitude of each cycle growing. And the only question is whether it twists all the way to the left and dumps into the drink, or whether it twists all the way to the right and dumps into the drink. And that would be the collapse of negative, into zero negative interest rates and death by default, or whether in the 1970s everybody thought it was going to rise, and prices and interest rates were going to rise to infinity, and the system would hyperinflate. Well, at the moment, it's looking like it's going into the default and deflation.
Well, I hope they can rebuild that bridge with scandium and turn it into a source of electricity in some way even. Let's get some engineering on that. Guys, thank you very much. We bring it to a close here. Mickey Fulp, thank you very much for calling in.
Thanks a lot, Peter and Keith.
Thank you, guys.
Keith, what a treat. Goodbye now.